Good afternoon, everybody. My name is Bianca. Welcome to this webinar we are hosting here at sennder. The topic for today's conversation is spot business versus contracted business. This webinar should last about half an hour. And just before I dive into the agenda, I'd like to just cover some housekeeping points. So everybody has been set onto mute. We have disabled the chat function as well. So if you do have any questions that you'd like Charlie or Cody to answer, please feel free to type them into the Q&A. And we will leave some time at the end to make sure that we cover as many of those as possible. Our agenda for today, Charlie will be giving us an update on the markets, some previous cycles and what the current statuses and trends are. We'll then be looking into the dynamics between spot and contracted business and what a good balance of that looks like. And then we've got some Q&A at the end. So again, please just make sure that you jot those down in the Q&A function. All right, without further ado, I'd like to introduce our speakers. So my name is Bianca. I'm a program manager here at sennder in the central team. And our speakers today are Cody, who is a program manager in the spot team, specifically strategy, as well as Charlie, who is our general manager in the Benelux office here at sennder. And they'll be speaking to you about each of those specific topics. So Charlie, I'll hand over to you and you can get us started.
Perfect. Thanks, Bianca. Hello, everyone. Good afternoon. Cool. So first, we'll start by looking at some of the macro indicators of where we stand today and the expected impact on road transportation. So I think a lot of those on the call are obviously very well in touch with what's going on, but I think still it's helpful to contextualize specifically in the conversation around contract and spot as the dynamics follow the macro indicators very closely. So on the left-hand side, you can see the Eurozone manufacturing, the Eurozone Purchasing Managers Index, the PMI. It measures the activity level and the performance of the manufacturing sector. What we can see for the second month in a row is businesses indicating that they're about to be or are already in a contractionary period. So yeah, what does that mean in practice? Basically, we've pulled out the German IFO Manufacturing Business Climate Index. It splits the data into two. One is, what is the business situation now? How is our business doing now? And two, what are the expectations for the future? And last year, they started to diverge when there were different expectations around COVID. And you can see that at the beginning of 2021. And they've remained very diverged with expectations much more negative than reality. And you can kind of see this gradual and consistent decline through the end of last year and today. And really a crash after the start of the war in Ukraine, beginning in February, and a slight recovery kind of before returning to more negative territory. And I'd say both items paint kind of a similar picture of inflationary fears, of increased costs of energy and general impact to demand. And in the next slide, we'll look a little bit closer at impact to demand, particularly related to the cost of energy. So I'll go over here. So on the left, you can see the German electricity price index. That's the price that providers are paying on average. And we can see that since the start of the year, prices have increased considerably, up over 500%. And as that trickles down to consumers, there are impacts to trade-offs in spending and ability to spend on other goods and services. So if you look at the graph on the right, it comes from ING. And yeah, they've taken UK household spending on energy, so gas or electricity, and placed this as a percentage of disposable income. And for each segment of income, you can see how much is spent on energy in 2021 and the forecast for 2022 in the orange and 2023 in the yellow. So you can see kind of a massive increase, particularly for the lowest 10% from 2021 to 2022, going up to almost half of overall disposable income. But even for median earners, going up to around 20%. And there is some expectation of government support to come around winter when usage increases, but regardless, consumers are likely to be curbing spending. And this does hold a potential impact on demand in other areas, depending on the segment and nature of the goods. Separately, it also holds an impact on freight pricing, particularly of fuel as a percentage of rates. We won't go too deep into this today. However, fuel mechanisms are an important component of contract business and the tender process, particularly now with so much volatility. They need to be set up in a way that keeps carriers compensated fairly, but also in which shippers are not overpaying when the market changes. And if it's not adjusted quickly enough, smaller carriers can just stop operating because of the amount of day-to-day impact that it actually has. So yeah, we'll go here to the New York Federal Reserve Global Supply Chain Pressure Index. I'd say it's a slight silver lining to kind of a more grim picture of decreased demand painted on the last two slides. And essentially it shows the ease in which manufacturers are able to source global inputs for goods and takes into account manufacturing surveys as well as inputs for ocean and air freight. You can see, if you look to the right of the graph, it remains elevated from historical and kind of pre-2020 levels, but it is decreasing, meaning that the level of overall disruption is decreasing in the current environment of potentially falling demand. And we do expect that trend to kind of continue into the coming year. And then lastly, I think it's helpful to zoom out for a moment and kind of get some historical context of other periods of economic contraction. So this just gives a view of the last 20 years. And you can see during the onset of COVID, also the Great Recession and the debt crisis that followed, we saw aggregate freight demands or aggregate freight volumes decline in parallel. I think, it's relatively common sense and ties to some of the other macro indicators that I've discussed. But at the same time, there are many more variables in play now, and particularly in Europe. And I think that increases the potential for volatility in the market. So we'll go here. So what are the associated challenges today for the shipper? Well, I think one, in terms of increases in variability in cost, and you see that in fuel and labor and other input costs. There's also a high degree of fluctuation that comes in spot rates with a lot of changes in capacity dynamics. And also, while dealing with these items of trying to optimize and understand cost, it's also imperative that shippers are looking at service levels. So things like real-time GPS visibility, carbon emission reduction, ops efficiency increases, et cetera. All these items have become increasingly important. And I think it sets things up for an environment that's very dynamic and hard to predict, and in which potentially favors a multifaceted approach to contract and spot, depending on the nature of the business. So I'll hand it over to Cody to talk a little bit about these dynamics as it relates to the spot market, and then we'll come back and talk a little bit about contract.
Thanks, Charlie. Just in general, obviously over the last few years, as Charlie alluded to in the macro update, we've seen significant challenges between this ever-changing supply chain shifts. Spot's become a much bigger player, and how you optimize spot is really kind of relevant to how effective you're going to be in reducing costs and reducing and changing some of these challenges for the better. So some of the things I want to touch on over the next two slides is really what's the current market trends from a spot perspective in terms of cost, in terms of capacity, and then in terms of opportunity. And then at the end, I'll wrap it up with how as a shipper, you can best leverage the spot network from a freight forwarder perspective, how you can utilize it to better make your supply chain more efficient, and some of the tools to best use it with collaborating on the contract side. So with that, let's move to the next slide. Okay, so what I have here first from a spot perspective on the cost side is TPO Insights year-over-year trends over the last 4 years. So what we're seeing is, as Charlie alluded to, and obviously heavily driven by fuel increases with the Ukraine-Russia conflict going on right now, over the last year, we've seen significant increase in cost from a spot perspective. Right now, we're seeing since 2020, roughly spot costs as of August 2022 are about 40 percentage points above what they were back in 2020 and 2019 in terms of in August. And with that as well, over the last year or 8 months, we've also seen the trends of costs significantly increase as compared with the years past. So the average month-over-month increase reflects roughly 2 percentage points upwards, whereas prospectively in 2019, that metric was 1 percentage point downward. So we were seeing a negative trend in costs. So naturally, we've seen significant increase in costs, but a promising sign in the trends that I want to allude to moving forward is we are starting to see initial signs of some slowness, particularly on the spot side. So for example, as of August 2022, this is the first August since 2019 that we've actually seen costs reduce as opposed to increase, which is a sign of potential slowness. Some of that has the impacts of diesel prices in July going down a little bit for the first time in a few months. But at the end of the day, it is an initial sign of potential change. And then with that, I want to touch on the capacity side of things. So the right chart reflects the last 2 years. This is also reflective of the Transporeon Insights data. And the most important line on here is the blue line at the bottom. Essentially, as that line reflects downward, we're seeing less capacity and less available capacity in the market. If that line goes upwards, we're seeing more available capacity. So just a small sample size, particularly in the last 2 months, we are also seeing a downward or an upward trend in available capacity over June and July, which is another metric that we haven't seen that case in the last 2 years plus. So we have seen an increase in available capacity. We've seen a slight decrease in cost in August, which promotes to some market slowness despite the significant cost increase over the course of the year. So next I'll touch on is opportunity. So from a shipper perspective, a big key case is how much opportunity from a shipper side are we inputting into the spot metric. You want to obviously limit that as much as possible because it's going to be, the more opportunities in the spot market, historically, it's a higher cost. So Charlie, if we could go to the next slide. So what I have here is reflective of Sennder's internal TMS opportunity data. So we are pulling all of the opportunity that we see from a spot perspective on the TMSs that we are participating in. And that reflects on the chart on the left. So this data reflects backwards of January 2021 and goes up to the end of August of this year. And the most important figures here is reflective of what's going on from 2021 to 2022 over the same time frame. So the key figure here is from March 2021 to September 21, we saw a 145% increase in total opportunity from a spot market perspective. So shippers were significantly increasing their opportunity and putting their shipments into the spot market over the course of those months. Now, traditionally, those months are generally busier, but what we're seeing right now as of 2022 is we're starting to see that number actually reflect downward. So over that same time period of 2022, we've actually seen a 14% decline on average month over month. Now the opportunity size are still significantly higher than what we traditionally see, but the trends over the last 4 to 5 months have shown that the pattern for shippers utilizing the spot network, meaning they're getting more capacity, is going downward. And as of right now, we're sitting at about 111% above what it was at the beginning of 2020. But the trend is pushing downward, and meaning, like I said, capacity is starting to maybe be more supportive from a spot perspective and from a contract perspective. Now, the second side of this chart is the industrial side. So some of you may be a part of either the food and beverage verticals as a shipper or the manufacturing and industrials. And so what I've pulled here is what the peaks and lows have looked like in opportunity over the course of the last 2 years as well, and what the month over month change has looked like and reflected in those specific industries. And so both of those industries in July of 2021 saw peaks in terms of month over month change and increase in spot market opportunities. So the shippers in those industries were putting their highest amount of spot loads into the market. And for the food and beverage industry, we saw roughly 91% increase. From the manufacturing side, we saw roughly 79% increase. And now reflective of that, what we're seeing this year over the last 3 to 4 months is a different change and a shift over what is traditionally a very peak season for food and bev particularly. For them, we have seen the month over month change steadily decline. So we're seeing a more stable environment in terms of opportunities. As I spoke to before, the opportunities are still high, but it's slightly more stable. We're seeing decreases. There's less peaks, which means capacity is being more supportive from the contract side. And then the second aspect on the manufacturing side, we've seen a 46% decrease in total opportunities since May of this year. So we are seeing less spot opportunity from the manufacturing industries into the spot market, which is also some more indications of market slowness. So now with that, I'll move on to the last point, which I want to touch on is, while we are seeing signs of slowness, it's important to understand that spot moving forward is always a relevant player in terms of logistics and supply chain, and how you utilize it is significantly important. So what's important is, number one, plan for a percentage of your spot network to essentially enter the spot market. The reality is over the last 4 to 5 years, we've seen that there's so many different events that can affect the climate of what's going on, between unpredictable events like COVID, Brexit impacting the EU, the mobility package impacting the EU. Now we have the Ukraine and Russia conflict that's impacting it. We just don't know how quickly things can shift. So how you structure your procurement methods in spot is very important because you need to be flexible. In order to do that, some aspects of utilization of, some shippers utilize TMS spot networks in Transporian, in Oracle, in different aspects. So you can utilize that to manage your bids, understand who has the lowest bid, things of such of that nature. And then the other aspect of it is shifting your carrier network potentially on the spot side to a more broader carrier network. So expanding your carrier network through freight forwarders, which gives you more access to last minute freight needs. So traditionally spot is an area where you're going to see spot freight come about with less lead time, or it becomes less notice from the contract carrier that you need to get that carrier, that shipment moved, or a spike in demand. You need to be able to have flexible carriers or one single carrier that has an access to a large network that can get those loads moved effectively in different geographical locations. And in order to do that, it also enables, if you do, expand your network potentially through a freight forwarder, you can reduce your operational costs, because some of the highest parts of operational costs are re-procurement, of having to constantly find a new shipment, a new provider for that load, carriers giving back loads consistently. If you have a single source provider, you could potentially enable them to handle all of the operational burden of your requests, and shift that away from dealing with potentially a network on the spot side of 150 carriers or 200 carriers, or even 20 or 30 carriers, and shifting it down to maybe more larger carriers or larger freight forwarders that can pivot the operational burdens away from you. And then the last part, and I think most importantly, is don't always think of spot as necessarily a bad aspect of the industry. Traditionally, if we do start going in a direction where the market significantly softens up, it's a great place to use and look at your low volume lanes, engage pricing transparency, work with freight forwarders on pricing transparency, work with your single source provider if you decide to go that route, and understanding what prices are looking like. But then you also can look at, okay, I have a low volume lane that traditionally always gets rejected because carriers don't like the time that they receive it on an RFP. Let's just start only using those lanes in the spot network, utilize them as a way of understanding and gauging what the spot price is in the current market, and see how our contract is performing versus what the network looks like at that point in time. So those are some key examples, I think, from a spot perspective of how you can be utilizing the spot network moving forward. And then I'll let Charlie touch on the contract side and close things out.
Cool, thanks, Cody. So yeah, I'll speak pretty briefly about this. There's less data that we can show here. That's not just kind of the overall macroeconomic picture, but this graph does show contract rejection rates from Q3 of 2020 through to the current month, which is basically what percentage of contract loads are carriers rejecting from the routing guide. And it's increased as a percentage fairly consistently, but even more elevated kind of in the 15% range from July 2021 through to June 2022. I think notably, we've started to see in the past 2 months a little bit of a decline. So what does that mean? Kind of tying to Cody's insights, effectively means that carriers are sticking more closely to contract agreements, or they're starting to, possibly part of that is less spot opportunity to go after in the market, and demand kind of decreasing. Theoretically, it could insinuate that it could be more advantageous to have a higher percentage of business contracted. However, there are some caveats with that. Things do remain volatile and could change. And also, if everything is contracted, you're not necessarily keeping a strong pulse on the market and market pricing, and it depends on when those rates were contracted or what time period. Cool. So kind of to wrap things up here. I think overall, the projection for the market is impossible to know with certainty. I think it's interesting to look at some of the trends to understand where we could be headed and some of the associated strategies. And in the end, what could be valuable is to maintain a flexible strategy that is diversified. And there are some facets that I think could be helpful. So one, in terms of planning, working with partners that can support in understanding risk, and also support directly with both types of business to have some degree of flexibility around contract and spot, and to, as Cody mentioned, engage this broader carrier base. And then two, in terms of optimization, I think there's process automation to look at on the contract side in terms of order ingestion and communication, and also eventually with pricing on the spot side. I think there's a lot of inefficiency in both areas that exist in the processes and communication today. And then in terms of transparency, so not only working with partners that can support in direct visibility and kind of limit service disruption as a result, but also having very transparent and open conversations about pricing and capacity in the market. And then maybe just as kind of a closing thought, I think in the future, it would be beneficial for both parties, the carrier and the shipper, to veer away from super strict contract processes. I think in the long term, it's a healthier market if procurement happens in real time and according to market dynamics. And I think there's a lot that needs to happen there from a technology perspective to kind of get us to that place where it makes sense. But, say, for example, in the context of the market overview, demand does start to decrease considerably, and there's a surplus of supply in the market, say in Q4 or Q1. If a significant amount of business is locked in via contract at that point, you may be, as the shipper, paying above what the spot rates are, and it's difficult to imagine now because spot rates have remained so elevated, but it can certainly happen. And I think the point is that pricing and capacity will always oscillate throughout the year, and some years more significantly than others, depending on everything that's going on. But I think the future is better real-time pricing and procurement through digital channels to kind of help better maintain transparency. And I think, businesses that are building technology to support that will be well positioned as partners in the end. Cool. So I think we'll leave it there. We have a few minutes for Q&A, and I think there's a couple questions already in there. I can't see them, so maybe Bianca.
I'll read them out to you. So we've got a couple of questions that have come through. The first one is, I think this is more directed at Cody, but would you say there are different seasonalities in spot opportunities between industrial manufacturing sector and FMCG sector?
Yeah, I think traditionally you see, food and bev is pretty, seasonal and standard in its own right, in the sense of you traditionally see in late March, early April, and May, you'll start seeing spikes as the warmer months come about, particularly on the beverage side. And then as the months come to a close, you'll start seeing it wrap up towards, beginning into September, and then maybe you see a little bit of spikes in the holiday season. With the manufacturing side, a lot of it can also be driven by what's just going on in the climate of political and within the nation itself, or around the EU, and how much investment is being pushed into those areas. In the US, they just put through a massive industry bill across a couple of months back, or earlier this year, which is going to have a huge impact on what goes on in terms of how, companies plan out that moving forward. But I think the seasonality of it shows traditionally that it's going to just be impacted by capacity, and capacity follows the trends of summer months peaking, particularly driven by the food and bev side, and then in the winter, December and November, because of the holidays. So I think manufacturing follows a similar aspect of it, just because of the capacity entering and leaving the market. And hopefully that answers your question.
Great. Charlie, I'll pick one out for you. By mentioning super strict contracts, you mean avoiding long-term inflexible contracts, which is more than 3 months or more in duration?
Yeah, I think it's a good question in terms of like the optimal period for contracting freight. And I think largely it depends on the nature of the business. I think for extremely regularly cadenced freight, it can be sensible to look at a longer contracting period, say for a year. However, given all the volatility that we've seen in the past several years, I think maybe a more apt strategy could be shorter term agreements. And not to say, you're constantly repricing with your carriers, but maybe on a quarterly basis, you're coming up with certain benchmarks to look at with suppliers to understand if, repricing in either direction does make sense. And, maybe there are inflation metrics or, insights from certain government or private third-party data sources that, can be agreed upon. But I think what we've seen with long-term contracts is that, carriers start to fail on the routing guide when the pricing no longer makes sense. Then it's, this big operational challenge from the shipper's perspective to kind of retender those lanes. And it, takes a lot of time. And again, just more ops work, I would say. And I think if you come up with a way to do this a little bit more regularly and, position to both sides when the market is soft or more tight, it can help from a service perspective and maybe be a more advantageous strategy.
Great, thank you. I've got another question. I think you might both want to give an input here. So one of our listeners is saying, we are facing significant challenges in the pack market due to high inflation. I think he means packaging, supply demand disruptions. Contract model is unable to maintain our profitability, and we have moved all shippers to spot. Is spot the only solution, or can we develop some pricing model that can sustain contracts as well? Sorry, he's just clarified, pack is Pakistan. Do you want me to read it again?
Yeah, I might need one more time with the question.
It's a long one, yeah.
Yeah.
So he says, we are facing significant challenges in the Pakistan market due to high inflation, supply demand disruptions. Contract model is unable to maintain our profitability, and they've moved all their shippers over to spot. Is spot the only solution, or can we develop some pricing model that can sustain contracts as well?
So yeah, I'm slightly confused with the question, because maybe you're saying that you've moved all carriers to spot, and I don't know if that's become a more expensive option than contract. So I don't know. It might be helpful to clarify there. I think there are some things to look at in terms of like a potential cost plus model. Again, I think there's not like a perfect system for this in Europe. We've tried a few things to try to be creative around, metrics that we could look at in combination with the shippers that we're working with. So some of the ones that I mentioned there's certain inflation metrics for certain countries in Europe. There's certain third-party data sources, for example, from Transporion, that you can use privately, or other government data sources that you can look at on, a quarterly basis or biannual basis to understand, which direction are rates moving, and can you kind of benchmark those to the rates that you're seeing and have conversations around that. So that could be a way to, look at it still on a contract basis, but again, look at it, I guess, with a higher degree of frequency. So yeah, I'm not sure if that answers the question, or if Cody, you have anything to add?
No, yeah, I mean, I was really just going to touch on, I think the value of there's a balance in that re-navigating your network, right, from a spot perspective, help readjust and see where's the guidance coming from, how are these carriers operating, who's the carrier that's operating, or the carriers that are operating most effective, and then working with potentially those on what Charlie touched on potentially a cost plus model or short-term pricing model that operates, when the peaks of the months are currently 2 to 3 months long, or, maybe 4 to 5 months, and reevaluating the performance from there and your costs, and re-examining. I think Charlie hit on it pretty well.
Great. He's just messaged to say that it makes sense. So that's good. We've got another question that says, we've got 1 minute left, so I'll just use this one and then wrap up. Will pure forwarders without own assets become more or less important in the near future? I think that might be for Charlie.
Sure. I mean, we can maybe both touch on it. I mean, from my perspective, I think given all the volatility in demand and also in the market that we've seen, I think providers that can fluctuate with kind of the market are advantageous to work with. I think, as I alluded to before when I was talking about kind of the ideal contract period, if there are, pockets of freight that are extremely consistent, say, 1 load per day, every single day, there's not going to be that much fluctuation in demand. Asset-based providers can be, advantageous for that sort of business. However, their flexibility around the amount of supply that they have is also, more limited, I would say. So I think working with providers that are trying to aggregate supply as much as possible, and then utilize that for flexibility in certain periods of the year. And it also kind of alludes to pricing flexibility, because as demand increases, it impacts pricing in certain periods of the year. But I would say, given this volatility and also some of the trends in e-commerce increasing in certain parts of the year and things like this, I think that flexibility is, becomes increasingly important. And I think, providers that don't own assets directly, but, work with a number of different providers will be well positioned for that.
Great, thank you. We are 1 minute over time. Thank you very much, everybody. There's a couple of questions that we didn't manage to get to, but if you would like to speak to us directly, please don't hesitate to reach out, and somebody from our sales team would be able to have a conversation with you. Otherwise, have a great afternoon and thank you for attending.